Our webinar where we will talk about leading indicator forecasting and how you can use that to communicate to your financial markets. Today we have two guests, Han Mesters, who's from ABN Amro, and our CEO, Professor Dr. Bram Desmet, who will elaborate a bit more on this subject. All right. So let's take a look at the agenda. So I'll give you a short introduction on Solventure Life, and then I will give the word to our guest speaker, Han Mesters, who will talk about market trends and what you need to take into account when you're gonna share your story with the financial markets. Later on, our CEO, Professor Dr. Bram Desmet, will then show you what tips or tricks you can use to enhance your story and to build more trust. In the end, we will leave some time for questions and answers. If you have already some questions during the webinar, do not hesitate to already enter them in the question panel on your webinar device. All right. So Solventure Life, who are we? At Solventure Life, we're specialized in advanced predictive analytics. For the past 5 years, we've done a lot of research into how external information can improve our forecasting and planning practices in the company. What we've seen is that by including external information, we not only generate a lot of insights in what is really driving your business and how the market environment looks like, but also how can you improve forecast accuracy. So what we've done is we've built a tool where we gather information from all over the world. So we've now gathered up to 2 million global indicators coming from various data providers, such as the FRED, who covers more US data, also OECD, which is more global, Eurostat, the National Bureau of Statistics of China. So we have a lot of data there, and what we do is we match that external data with your sales and see which indicators are really relevant for you and which you need to take into account when you're doing your strategic, your tactical and operational planning. We see that in different types of industries, there are different types of external factors impacting that industry. For example, if you're in a more B2B environment, more chemical, process, or discrete, high-tech automotive, we see that macroeconomic factors really play a significant role. The influence of the oil price is more relevant than a kind of promotion you do, because in B2B environments, promotions are not so prevalent in the business practices. In contrary to, of course, FMCG and retail, where events and promotions really play a significant role in estimating the demand and shaping that demand. So that is something which you really need to take into account when you're in these kind of industries. And as you see, we have references across all these different types of industries. So we're definitely experienced in different types of modeling and finding external information for your specific company. And then Solventure. So Solventure Life is one of the products of Solventure. Apart from the leading indicator forecasting, we're also doing sales and operations planning. So in the Solventure S&OP products and services, we offer a range of sales, inventory and operations planning where we focus on people, process, tools, and analytics. So it's not only the process which is important, it's the tool really which supports that process. And the people who have to work in that process are, of course, very significant and very relevant to get your planning right. So what we do there is software and software-based consultancy, and we use the Archiva software for the S&OP planning. Then there's also our Solventure Academy. So this is a training institute where we organize trainings on different supply chain topics. So going from demand up to executive S&OP. We organize specific accelerator days on these topics, or we also make tailor-made trainings requiring or adapting to your company needs. So if you want more information, visit our website at solventuregroup.com. And of course, do not hesitate to get in touch with us if you would have specific questions. All right. Now I will give the word to Han Mesters, who is going to give you some more information on how market trends can influence you as a business.
My name is Han Mesters. Thank you, Deborah and Bram, to give me an opportunity to share some knowledge with your clients and to some extent probably our clients as well. I have, let's say, 20-25 minutes, quite a lot of stuff to share with you, so let's start right away. The first slide is a nice image of our company. More important, the building in front of that slide tells you something about our strategic direction, which is, let's say, giving shape to the global circular economy. And so you see that this is an important part of the strategy of many companies these days, especially in the industrial environment, but also in the financial environment. Because, you know, we are facing a world with increasing number of people. There's limited resources in the end, so we have to rethink why are we here on Earth as a company. And that does not mean that the only reason you exist as a company is to maximize profit. And that's a very strong force. So that's also embraced by the younger generation that we have to take into account. So that's why I thought, you know, let me show you what we as a bank do to give that a bit of a face, so to speak. So I have a couple of chapters, so to speak. First, a little bit about trends, what's going on in the world. In my job as a sector banker, I have the privilege to think about the future of companies, especially my sector, which is business services. And there's a lot of interesting global trends happening. So I want to share with you. Then the macro environment. So what can we learn from the macro environment when it comes to communicating results and getting a clearer picture of the future? And this is interesting for me because I used to be an investment guy for 7 years. So I used to work in global equity markets as a fund manager of one of the funds in ABN Amro. I was responsible for the industrials fund, which also included the services, by the way. Now, another level of analysis to look into the future is, of course, the sector or the meso level. I will spend some time on that. And in the end, of course, it's all about individual company performance. And as an analyst, of course, I have a lot of experience with analyzing company results and trying to get a picture of how they are doing. So if we go to the trends, then you see something very interesting. Worldwide, I think, especially in the Western world, there's kind of a shift going on from 20th century hierarchical-based institutions to much more flatter organizations, into the extreme form of communities. And the nice thing is that these new ways of coordinating capital and knowledge is embraced by the younger generation. So the younger generation clearly has a preference in working in flatter, informal organizations, and institutional organizations are not doing very well in keeping and attracting talent. That's a fact, and that's very unfortunate for an institution like ours. To give you some ballpark figures, the trainees we hire and we invest in, after 3 years, 50% of them is gone. And we are not the only ones, and so it's really starting to hurt. And then if you combine that with the picture on the left side of the slide, that's from a General Electric investor presentation more than 10 years ago, I think 15 years ago, where Jeffrey Immelt said somebody hit the reset button. So a lot of best practices that large organizations kind of incorporated in their strategy and operations, well, they have to rethink them, especially now in these days. The nice thing about my job is that I can spend a lot of time with startups who think about the future and how work should be organized. And this is one of the startups I learn a lot from. It's called Parder, and they have a kind of evolutionary picture of how the governance changes the way we organize work. So we start in 1.0 with the traditional hierarchical organization, and the picture on the left. Then if you move one up, one higher to the right, it's let's say a organization that combines hierarchy with the agile way of working, so teams that kind of manage themselves, which is quite popular, same in our organization, but also with ING, one of our competitors. And then the third phase is, let's say, the fully self-regulating, if you like, organization. So there's hardly any management left. That's quite a dramatic change, of course. And the final phase, the end game, if you like, is a bit like the American movie industry already works for over 100 years, which is the ultimate project organization. And so you start with a film script, you get money, financing, then you look for a location, you need directors, you need actors, and when the movie is finished, this whole project organization kind of falls apart, and then the next project starts. And already in my sector, business services, you see examples of this way of working, especially with startups. Then another thing that takes place is this, on the next slide, this nice word, disruption. And basically it means that the enormous changes in ICT and in IT, but also artificial intelligence, deep machine learning, processing capabilities by computers has a very dramatic effect in that sense that jobs that can be described from a process point of view will be automated. So a lot of the, let's say, medium level educational type of jobs, administrative work, process operators, they're gone, and these jobs are gone. And this is not a financial problem, this is a societal problem. What are we going to do with all these millions of people in all kinds of industry that don't have a job anymore and who are very difficult to place in a new job in other sectors? In summary, the overall level of work is increasing. It's a college plus type of education that is the starting point, which is scary. Then there's more going on, because if you look at the next slide, the S&P 500, so the largest listed companies in the US, and you look at two important metrics, how the investor community looks at these companies. That's of course the earnings per share growth, so how profitable are they, but also sales growth. And there you see that the earnings per share growth is kind of declining. If you look at the upper left graph, it's a bit increasing now because of the economy doing quite well. But in general, if you look at the trend, the earnings per share growth is declining. And even more worrying, if you look at the picture on the right side of the page, the sales growth, the oxygen of profits, so to speak, sales growth is not going anywhere. So the conclusion is that in many sectors, many companies have reached the end of their business models. They find it difficult to extract value from the existing business models, and more important, the capabilities to innovate are not present. So that brings us to the next slide, which is a very influential study by Boston Consulting Group. They studied the same group of companies, which is the S&P 500, in all kinds of different sectors, and they concluded that basically in these days you need two important competencies. You need to be able to do exploitation very well, but also exploration. And exploitation is, let's say, the traditional institutional organization. So it's all about short-term shareholder value, optimization of processes, KPI-driven, sometimes called spreadsheet management. That's a very important skill, of course. It used to be a very important skill, made many companies very powerful, very rich, but the unfortunate truth is in these days, it doesn't mean that much. Also, a lot of the activities in the left side, on the left side exploitation, are being automated. So what you see is a dramatic underrepresentation in terms of competencies in the exploration field. So where you have to think long-term, be good in innovation, embrace the outside world. And the Boston Consulting study showed that only 5% of the companies in the survey were able to deal with the two different worlds. So they had competencies in both worlds. If you then look at the next slide, which is from a book called Purpose. Purpose is becoming more and more important. I'll speak about it a little bit more further on. But purpose is important because it's what people expect from you. Why do you exist? But more importantly, young, talentful people, they love to work for a company that tries to make the world a better place. And that may sound a bit strange for executives with the age of over 50, but it's a fact of life. So if you don't get access to this young talent, you will suffer. So you have to think about how to incorporate purpose into your communication to the outside world, to your future colleagues. If you don't do that, you lose out in the end. You lose out. So it's not so much about branding anymore. It's about where do you stand for, so the right side of that graph. In other words, your employer branding becomes even more important than your corporate branding. In the end, it's the people that make the difference, not just in my sector, but also in the industrials, for example. Then the next slide is about the very hungry caterpillar, which is a Dutch fairy tale for kids. Basically, it means that the way we evaluate companies, also from a listed investor point of view, is that we always want more and more and more. We want more sales growth, we want more profit, and of course everybody knows that more and more and more, so eternal growth is a bit difficult on a planet that is limited in size. So soon we will have a situation where we have more than 8 billion people, 9 billion people, and there will be a shortage of resources. So we will certainly reach a tipping point where we have to figure out something else. Right? So it's not going to be more and more and more. And that's, of course, this is the best way to support the transition towards a circular economy, where we, try to do something different to justify the existence of company, not just more and more and more, but also have an impact on society and be more circular. Then, if you combine all the things I've discussed so far into the next slide, I've done a MBA. You could see that in the picture, Master of Boxes and Arrows. And basically, two axes are quite important. One of them is why do we exist? I've talked about that. There's three options basically. First of all, you're profit based. Second is you care about people, planet, profit. So there's more than just making profit. And if you go to the extreme, you're a social enterprise. That means your prime reason for existence is that you want to solve problems in society. Of course, you have to make profit, but it's not your guiding principle. And in my sector, you see a lot of startups who start as social enterprise. So that's one axis. And the other axis is the way your governance works. How are you organized? Are you a traditional hierarchical organization? That's so 20th century, so that's really dying. Are you agile? Do you experiment with teams that work without a manager but that manage themselves? And also you can go completely wild and be a holacracy, which is basically a company that has no management. That, of course, the scalability is limited, but you see a lot of let's say professional type of environments like software programmers and startups who work in a holacratic type of environment. And no matter what you do as a company, you have to move upward to the right, whether you like it or not. So the 21st century the winners will be in the upper right hand quadrant of this graph. Then, if we look at let's say the breakdown of how investor communities look at listed companies, but also stakeholders in general to non-listed companies, you could start with a macro type of analysis. And there you see that, for example, if I took the Netherlands as an example, we have a very strong economic growth now. We aim at 3.1% for this year. And for next year, we think it's going to be 2.1%. My colleague economics, but that might be on the low side. The reason why it's 2.1% is because we don't know exactly how Brexit will work out. But I wouldn't be surprised if we could actually beat the 3.1% of this year next year, provided there's not going to be a nuclear war with North Korea. But no, okay, that's then we have some other problems. And also my sector, business services, is doing extremely well. So it has the highest growth of all the sectors we look at. So that's good for my sector. So basically, my sector is sensitive to economic growth. The same applies for industry, for transport. If the economy is doing fine, then those sectors do extremely well. Of course, if the economy is going nowhere, then these sectors suffer. So it's important to know from your company and your sector what your beta is. Your beta is an investment term that basically explains the sensitivity of your turnover, of your sales to the macroeconomic environment. Of course, when you talk about cycles, me being an economic historian, there's different ways of looking at cycles, and the shortest cycle we're all familiar with is a 7 to 10 year, let's say, economic cycle. From biblical times, we know that cycle. But there's many more cycles. We have a 39-year generation cycle. So the generation that enters the labor market now is what they call the Generation Z or Einstein, the young kids, different mindset. I'm from Generation X, and before me is the baby boomers that are now in the process of retiring. You have a geopolitical cycle of an average age of 35 years, and you have a 45 years innovation cycle, and that's an important one. If you go to the next slide, you see that the innovation cycle is linked to major inventions. And according to this theory, we are entering the starting period of the sixth Kondratiev 45 innovation cycle. So that's good news. That means we've had the worst behind us, and now we have a period of 30 years of economic growth. Well, I hope Kondratiev is right. Not all economists would agree. The cycles from a macro, the indexes from a macro point of view, we use a lot within the bank is the PMI index, the Purchase Managers Index, and that shows a nice correlation with GDP, so with the national economic growth. And so it has a strong leading indicator potential. Our macroeconomists use it a lot. 50 is kind of the threshold, so when it's above 50, it's good news. And you see in the part where it says impressive recovery that everything is looking fine. If you look at the leading indicator message of this graph. The next one we use a lot is the ESM index, which is basically manufacturing based, and there again you see also this 50 threshold. Look at the graph below. There's two variants we look at. First of all, the US ESM, and the other one is the same thing. It's called the IFO index, and this has proven to be also a very strong leading indicator. It's also nicely correlated to GDP growth. And again, if you look at the most recent data we have, the outlook is fine. It's extremely good, actually. My colleague Han Mesters, our senior economist, has never been as excited in the past 30 years based on the graphs he has seen. So that's good news. So that basically means next year is going to be fine, or run for the hills. We've reached the top of the economic performance. Who will say? Inflation, of course, is another one, quite important. And there you see that if you look at the total inflation, the US is above 2%, but where the type of inflation we look at is called the core inflation, where we exclude commodities, what they call commodity-led inflation. We get that out. And then you see that both for the Eurozone and the US, the inflation is actually below the 2% target. So that's kind of worrying, especially after all this monetization, all the effort we've done to support the economy by providing liquidity, and still we have less than 2% inflation. So some people say we are living in the biggest monetary experiment that one can think of, and it's still unclear how this will end. If you look at the sector level, so the meso level, we have a number of important forward-looking indicators. The one I like very much is what they call the air freight indicator. That tells you something about expensive capital goods that need to be shipped by plane because the demand is increasing. So this is not the UPS and FedEx, the parcels. This is very expensive production capacity, capital goods that needs to be flown out. And there you see a strong increase, and historically that always has been a sign of economic recovery. The other one is called the staffing indicator. In my sector, I look at the employment services companies like Randstad, Adecco, Manpower, and this sector traditionally has been a very strong canary in the coal mine, as they say, so it gives you an idea about what the economy is doing. And the correlation is a bit less now, but if you look at the graph, you see the shaded gray areas is recession, and you see that the temp staffing growth is actually declining before the actual recession takes place in 2007. So in 2007, it certainly still was a canary in the coal mine. Now it's getting more real time, so it's losing its original importance. One of the other things I use in this meso level is the packaging index. If there's a lot of demand for plastics or carton or paper, then you know that the production output is increasing, and this increases before that the economy increases. So the packaging index is a very important one to look at as well from a leading index point of view. And the last one I would like to share with you on the meso level is the Baltic Dry Index. And there you see that the choice of the horizontal axis is quite important. There you see an increase of the Baltic Freight Index. Baltic Freight Index basically means if you were to order a ship with crew to transport maize, iron ore, coal to any place in the world, how much would it cost you? So obviously, the more expensive it is, the more demand there is. But if you look at the next slide, you see that the so-called recovery is really meager if you start the horizontal axis in the year 2003. So it's not that strong as one might suggest from the previous slide. And the third slide is even more important because this picture gets distorted by the number of ships that are being produced. So the capacity component in drawing conclusions also is very important to take into account. In general, if it increases strongly, the Baltic Freight Index, you know that China has more need for raw materials, for commodities. I think that conclusion can still be defended. And finally, on the micro level, I put my hat on as an analyst, portfolio manager now. Things that you have to keep in mind if you look at companies reporting is the difference between, let's say, the P&L based results. The stock market works on earnings per share, which is a very crude way of assessing a company's performance, especially when it's an asset heavy company with a lot of balance sheet stuff like industrial companies. If the gap between the cash flow generation and the P&L earnings becomes too big, you have to be careful. In the end, it's always about cash flow. So that also is the same what I said. The second bullet point, declining operating margins and ROC, return on invested capital, is in the long term a much better predictor for the success of a company than the P&L based data. You see a lot of companies, of course, being very creative with non-operating profits. Always be careful when you see a lot of non-operating profits. Be careful when you see capitalization of interest and other costs. So they move it from the P&L to the balance sheet, very bad sign. Changes in inventories is also a scary thing to look at, especially when it's a big spike, a big change compared to other years. Then comes changes in accounts receivables, also something to look at. And finally, rising account payables, not a good sign either, from a longer year point of analysis view. As an example, I gave a sheet from the investor presentation from the largest company in my sector is Randstad, and this is a sheet from I think 2008 or 2009 when they were hit by the crisis, and they showed the investor community what they could do. So the top part of the graph shows you an example of controlled expansion. So how do they manage their offices, their outlets, when the economy is doing fine? Well, they split one office into two new offices, they hire new people, and the same thing works reversely in the example of the economy going nowhere, and they call that controlled contraction. So they take two offices and they change it to one office and reducing people. This is a way of being agile, flexible when things are not doing very well. And this ability to be agile is becoming more and more important in a world where we don't know how it looks like in a couple of years' time. So to summarize, if you are to survive in this century, there's three things you have in order. First of all, agility. We talked about that with the Randstad example. Your innovation power and company culture become very, very important. The lifespan of your business model is reducing. So you have to, in your business model, you need innovation as part of your business model. You continuously have to think about improving your product, but you also have to be thinking to come up with something completely different. And this is the thing that is not very well represented in companies. Most companies are very good in the running the company, the exploitation part, but less so in the exploration part. So you need to think about how do I fuel innovation. And maybe the conclusion is that you have to do it outside the existing company with different people. That's the route that we have chosen, and more companies do so. And finally, of course, in this whole transition of business models into internet-based business models throughout many industries, you see that the ICT infrastructure becomes very important. If you have made the wrong decisions in the past and you're stuck in a legacy type of IT environment, it's going to be very difficult to make this transition into the internet-based world that is more and more important in many sectors. So I would conclude with a slide called "Are you fit for the future?" And this is Amish Airlines that tries to run its own airlines, and I'm afraid this is a metaphor for many companies and sectors entering the 21st century.
Okay, Han, thank you. It was really a nice presentation, and I think it triggered a lot of questions with you all on how to really go forward from here. So, how are you going to use this information to really communicate to financial markets? So yeah, as you see that, like Han said, there is a lot of things that you need to take into account when you think about your company and when you're thinking about how am I going to present this to the outer community and to other financial markets. As you see, there's a difference between cyclical and non-cyclical companies. Something very important there is to take into account, as Han said, the beta value of your company and the beta sensitivity of your company, and how that really affects your sensitivity towards macroeconomic factors. So it's a very important thing to really figure out how how sensitive is your company towards macroeconomic changes. As you see, for example, there's a new upcoming Kondratiev economic cycle coming up where new technologies and innovation is really key. And yeah, that also triggers the question, how is this going to affect you as a business, and how are you going to gather all that information into your own forecast and your own planning of your company and your company story towards investors, and really make sure that your shareholder value is enriched and is still very valuable. So yeah, there are questions. How are you going to adapt to these ever-changing environments and different types of external factors which are going to influence you as a business? And yeah, how are you going to create trust? Because as a company, there's one thing of finding out, of course, what is impacting your business, but really being agile and flexible as a company to integrate these changes and be aware of these changes and adapt your business and your decisions you make. That is really important, and that's really important to keep in mind and to create trust in an external community. So what companies typically do, as Hannah as well said, your equity story, it goes beyond financial data. You really need to know what is driving you as a business and what are really influential external factors. If you're in this, if you have a great sensitivity towards macroeconomic trends, you really need to know what these macroeconomic trends are and how that's going to influence you. Of course, there's also a balance you need to keep, because you need to make a forecast for the future of where your company is going to go in the future. And as a company, as Hannah also said, it's important to also invest in innovation, because you want to be ahead and you want to be a game changer and you want to really stay ahead of the rest and really try to innovate with new products where you can go into the next years and go into the future basing on new inventions and on new qualifications of your products. But on the other hand, the investors also really are interested in knowing which products are delivering you the highest margins, and how are you seeing the future for these kind of products. So there's always a balance, like what are the products today, which are how are you going to present these, and how much are you going to invest in innovation. Of course, you do not have everything in control, and you can, of course, shape your equity story by communicating well, communicating your successes, communicating innovation, communicating at specific industry events what you're really doing and what you're investing in. And of course, getting an idea or a grip on how your company's growth is influenced by external factors. And one of the things that can help you there is really getting a good estimate of your demand. So really knowing what the drivers are of those products with the highest margins, what is really driving these products, what external factors are really impacting the sales of these products. Because of course, if you know that there is a factor which is actually saying or telling you that you might sell less of these products, you might need to invest more in innovation. So that's really a balance you need to understand there, and you really need to know what is driving your sales. And one of the things that we as a company have heavily invested in is really finding those indicators which can help you better get a grip on your sales, and really better understand which factors do I need to take into account, and which factors or external factors do I need to monitor to see how that product is going to evolve in the coming years. So that's really a big task of that investor relations professional, that he needs to really communicate trust. And you, of course, can do that by using some KPIs or some measurements or key metrics that can help you form that story. So sales indeed is something which you really need to, of course, get a good grip on. And I will now give the word to Bram Desmet, who will show you a procedure or how we tackle that problem, and how we can really focus on better estimating demand, and why it's really important.
Thank you, Deborah. Okay, so I see two aspects in the case I'm going to bring. One aspect is certainly what Deborah already said, is that we need to create trust. And if we want to inspire trust, we need to avoid surprises, because if I'm an investor in your company and you can't predict how your business is running, what type of trust would that create on my side? So that's certainly an aspect we should take a look at. And a second aspect is, well, on the one hand, the leading indicator forecasting can improve the predictability, and as a result create trust in the financial markets. A second aspect is that we also believe that forecasting can significantly improve the value of your business. So it touches your business on those two aspects. And when we look at how does it improve the value of your company, well, over the summer I've been writing a book on the supply chain triangle, which is shown here. And the general principle of the triangle is that we see that companies struggle in balancing service, cost, and cash in their company. Typical examples are that if I'm in purchasing, maybe I start sourcing in the Far East to reduce the cost, but I have overlooked the impact on the cash. Because of the longer lead time, I require more inventory, and because of more difficult quality control, some of that inventory might turn out to be bad and might need to be written off. Other examples of balancing the triangle is that salespeople or marketing people try to extend the product portfolio because they think it improves the service towards the customer, and it helps in improving the growth, or it helps in realizing the growth objective. But again, salespeople do not have a good assessment of what is the impact on the cost, and more products or a broader product portfolio typically also has an impact on the inventory, so on the cash side of the triangle. And on the one hand, this discussion is a supply chain discussion, but it's certainly also a financial discussion, because if service is a driver for top line, well, if you combine the top line and the cost, you get to a bottom line metric like EBIT. And if you look at the EBIT over the cash or the EBIT over the capital employed, you get something like the ROCE, or the return on capital employed. And it struck me in Hans' presentation that he says, well, on the one hand, investors are focused on earnings per share, but earnings per share are more P&L oriented. Well, the service or the top line and the cost are more P&L oriented. So the right side of the triangle is more P&L oriented, but we also need balance sheet elements like the cash. And the cash is basically the inventory, the payables and receivables. So it's the working capital. So balancing the triangle is a supply chain thing, but it's certainly also a financial thing, or it's also trying to optimize the value of the company. The good news is that improved forecasting really touches the three aspects. So yes, we want more. That also came in the presentation of Han. The good news is that improved forecasting helps in delivering more. So improved forecasting typically will improve the service, at the same time allows you to lower your cost and allows you to work with less inventory. And that's what's explained on this slide over here. And this slide basically explains the same thing. So if you can reduce your forecast error, you will typically have a better customer service, which will improve the top line. I will work with less inventory. I will have less inventory write-off. So basically that on both aspects improves my return on capital employed. If you want to know more about that triangle and some of the details here, reach out to us. We have a lot of things to share, and we have a full book coming up on the topic. But let's see how we do that. So how do we improve that forecasting? Well, we have been developing a new approach, which is based on including external indicators and preferably, of course, leading indicators into the forecast. And that links again to the exploitation and the exploration that Han introduced. We as a company, we are certainly also exploring new ways to improve forecasts in companies. So this leading indicator forecasting is based on 4 years of PhD research. And even before that, we have a couple of years of master theses into that subject. And today we have a product available which can operationally be used also at your company, in case you would be interested. What does it do? Well, traditional forecasting methods are simply extrapolation methods. So if I'm at the first dashed line here, well, if the historical growth has been 10%, the extrapolation will be 10%, right? So we basically extrapolate recent behavior. If I'm at the second dashed line here, well, if the recent trend was a decline of 5%, well, then the forecast will simply be a prediction of a 5% decline. It's what statistical techniques, traditional statistical techniques do. It's also what human behavior does. We have a short-term memory. So if last quarter was 10% up, it's almost impossible that people will come up with a 10% decline. No, we will typically base our forecast on recent observations. And these traditional techniques, the red line is good as long as there is no change in the trend. But the traditional techniques are very bad in predicting what we say turns or trend changers. And the goal of forecasting with leading indicators is, of course, that we can better turn those corners. So that's what we try to do with including leading indicators. And preferably, these indicators have a certain lead. So an example shown here is, if this is my indicator, well, if my indicator has a certain peak today, I'm looking for indicators which tell me, well, a peak today in the indicator will result in a peak in my sales within 6 months or within 9 months. And of course, the bigger the lead, the more value I have from that indicator. The approach, what does it give as a result? Well, it helps you to discover the real drivers of your demand. Han has shown 4 to 5 indicators which have a broader applicability in the industry. But if we really go to a micro level and if we look at individual companies, well, we can help you to discover the real drivers of your demand. We can quantify qualitative assumptions. I will show a case later on where the assumption was that there was a link to the oil price or oil production, and maybe that has always been the case. So it's kind of a tradition that we base our forecasts on that indicator. We can quantify and we can help you to assess whether it is still relevant, yes or no. Create insights in your market environment, and as a result, improve demand planning practices. We still see a big gap between sales and the forecasting process needed to steer the supply chain. If you work with external indicators, you have something to give back instead of salespeople pushing back to forecasting as being a technical thing. Salespeople are interested to better understand the drivers in their market. So doing driver-based forecasting or leading indicator-based forecasting certainly also improves the adoption of demand planning and sales, and as a result can improve your demand planning processes. Let's look at the case study. So this one is project we did with a global producer of steel. We took a look at one product group, important contributor to company margins, and what the basic goal was to have a better understanding of what is really driving this product group, to help the financial people in the company to create a better equity story. And so goal, better estimate demand, understand the drivers of the demand, and as a result also improve the demand planning in the company. What is our typical approach? We start with a workshop. In the beginning, this is relatively new, so you need to create buy-in. And how do we do that? We typically organize a workshop, which could be 7 to 10 people of your company. And we start with a mind mapping session where we ask people to bring up expectations on what is driving the sales. And some of them might be more macroeconomic, some of them might be linked to legislation, some of them might be more event related, like if import tariffs or changes in import tariffs may disrupt my market. In that mind mapping session, we bring up what people expect as important drivers. We complement that with a brute force analysis, because if companies would come up with 10 expected indicators, well, most probably like 3 to 4 of them are really confirmed. 3 to 4 don't have a strong relationship, and 3 to 4 we even don't find a relationship. And oil price could be a good example. Well, maybe your business was dependent on the oil price like 5 years ago, but since in the US we have started with the exploration of shale gas, something has structurally changed the oil market. The oil price have been extremely low for a longer period now, and that might have broken some links which historically were there in your business. So we start with the mind map, and then we try to confirm or disconfirm some of your expectations. We also do a brute force analysis, which brings up indicators which you were not necessarily aware of, right? Many people have blind spots, have gaps in their current understanding of market behavior, and data is abundantly available, and statistical techniques and computing power are, let's say, powerful enough to easily match your data to a database of 2 million indicators. That technology is available, so you should use it. And by bringing up new indicators, we certainly improve the understanding of companies of what is driving their market, and that creates a lot of enthusiasm in the marketing teams, in the sales teams, in the supply chain teams and in the finance teams to start improving that forecast based on those external indicators. That workshop is basically meant to make a kind of a business case and say, okay, which type of indicators are popping up to get a better understanding of what is driving the market, and to also assess, like, does this help to improve our forecast, yes or no? And we come up with forecast accuracy metrics. We really try to measure the leading indicator forecast, to compare it to traditional forecasts or even to your in-company forecast if you would have it available. Next step is typically a pilot where we say, okay, well, let's run these forecast models. Let's run them for 3 or 6 months in parallel to your existing forecasting process or your existing forecasting models. That will improve the trust in these leading indicator forecast models. And well, based on the extra insights you get from that pilot, we finally get to an operational use, and we have that operational software available, which can support that, let us say, in a monthly forecasting cycle. How does it work? That forecasting or that leading indicator forecasting technique. Well, this is an example of that steel producer. The black line is the historical sales. So the different dashes here are different years, so we have quite some history. You see a lot of peaks, right? The first thing is to get rid of the peaks. And the peaks can be either calendar seasonality. It could be that we say, well, December is a bad month. Why? All customers are trying to lower their inventories to improve their valuation. It's one of the metrics that Han was looking at as an investor, right? So we want to be low on inventory. So we don't sell to our customers at the end of December. If that is a yearly recurring pattern, we are not looking for a macroeconomic indicator to tell us this effect. We know that it's calendar seasonality. We also might need to take off events. If I know that my historical demand has been disturbed by a price increase or by a change in import tariffs, I need to account for that effect if I want to reveal the underlying macroeconomic trend. That's also what we have done here for this customer. So the red line you see here is the, let's say, underlying cycle, the underlying macroeconomic cycle after removing seasonality and after taking some events. And the next step is basically, well, trying to match this red line to our database of currently more than 2 million indicators to see, okay, what type of macroeconomic behavior is explaining that red line. The assumption in the company was it had to do with oil price, that oil price was an important driver for their sales. Well, if you look at oil price, well, we see a steep decline here in the sales. We also see a steep decline here in the oil price. So in a certain sense, we could say, well, if I shift the oil price with a couple of months, it could be that the oil price is a kind of a leading indicator for our sales. If I look at the second half of the graph, it looks relatively good, but it doesn't look good here in the beginning, because in the first half of the graph, we see that our sales is really going up and down, but the oil price, well, has ups and downs, but the level remains relatively constant over a longer period of time. Well, if we would use the oil price to make a forecast, the optimal lag appears to be 4 months. Well, that's a good lag, or that's a good prediction here for the steep decline in our sales in the second half. But you see that the forecast we would make based on the oil price for the first half of our sales pattern is really no good. And so again, this is an example of an indicator which sometimes companies expect as being causal, as having a relationship to the sales. But it's one of the indicators where we say, well, maybe over the last 2 years there is some relationship, but that relationship was certainly not there in previous years. So next step is then match that sales to our database and to see what other indicators are popping up. Yeah? What did pop up in that brute force statistical analysis? Indicators related to exchange rates, indicators related to certain raw materials, and indicators related to key supplying industries. And so in general, also indicators like employment in certain industries a lot of times appear to have a predictive power comparable to the message that Han has brought in his part of the presentation. So one of the stronger indicators, kind of a starting indicator for the model, turned out to be exchange rate. So exchange rate between two major continents. And what you see here is, if we look at the exchange rate, it's going up, it's going down, it's going up again, and then you have that steep decline. So it's comparable to what we see in the smoothed sales here, the red curve. It's going up, it's going down, it's going up again, and then we have that steep decline. So even visually, you see that exchange rate provides a much better fit compared to the oil price. If we only use that exchange rate as a single indicator to predict the sales, yeah, this is the forecast we get. So the blue line is the forecast for the red line. So you see that overall it provides a much better fit. Yeah? So to the left here again, we see the oil price. So there might be a good fit in the second part, but there is not a good fit on the left part. The fit for the exchange rate is much better. Different indicators will give a different outlook. Yeah? So if I would base my sales or my forecasted sales on the oil price, I predict an increase. If I base my forecast on the exchange rate, I see that the exchange rate has a downward pressure on my sales, right? So choosing the right indicator is really crucial. So understanding the true market drivers is crucial in making a good forecast. Choosing a different indicator here leads to a completely different forecast. Yeah? So For sure, exchange rate here is an important driver, but it's not the only driver. So what we see here, if we look at the exchange rate has a downward pressure on our sales if we look at the next 9 months. But there are other factors into play. And so we also saw that indicators related to raw material prices and indicators related to key supplying industries also have an effect. If we also take into account these factors, you see that the downward pressure of the exchange rate is more than compensated. So we end up with a kind of continued increasing trend. But this is really the conclusion of two counteractive forces, you could say. On the one hand, the downwards pressure of that exchange rate, and at the same time, the upward pressure from the raw materials and key supplying industries. If you would compare it to traditional forecasting algorithms again, well, as I told before, traditional forecasting methods are extrapolation methods. So the recent trend, if you really look at the recent trend here, well, that we had an absolute dip here. So the recent trend seems to be a steep increase. And so on the one hand, we could predict a strong increase. If you look at the last year and a half, sales seems more or less stable. So with traditional methods, you always have that uncertainty of, are we increasing or decreasing? Should I look at the recent trend or should I look at the long-term trend? I will not go into detail given the time in error metrics, but we can easily show that working with leading indicators does improve that forecasting trend. So some conclusions, well, on the one hand, working with us on that leading indicator analysis allows you to validate any assumptions you would currently have on what are expected drivers. We can certainly challenge that and probably come up with drivers you were not aware before doing the analysis. Yeah? And this will, on the one hand, lead to a better forecast, and a better forecast, as we have shown, will improve the value of the company. And at the same time, a better forecast also improves the trust when you communicate this type of forecasts to financial investors. Yeah? And then I will have Deborah doing the wrap-up.
Okay, so I see we're running a bit out of time, but I think the most important things that we need to remember from this presentation is that, to have a solid equity story, you really need to know what external factors are influencing your sales, taking into account that, are you a company which is very much influenced by macroeconomic factors, or are you a company which is actually not so much influenced by these external macroeconomic influences? So that's one thing. Also finding really a balance between which products are you going to show, or which products are you going to put a high focus on in your equity story, where you think of innovations as something very important, but also, what products in my existing product portfolio bring you the highest margins, and how can I ensure trust and create shareholder value by really understanding what drives the sales of these products. And then, of course, as Han as well said, there are disruptive environments. So as a business, you really need to challenge yourselves. What are new technologies gonna do with my business, and how are they gonna change the way you're doing your business? So that's really something you need to keep aware of, and really try to keep on innovating and going forward and stepping ahead of the game to really ensure your growth into the future. And if you understand these external macroeconomic factors which can have an influence on your sales, I'm sure you're gonna create trust in your financial external markets you're trying to show how your company is doing. Thank you, Han.
Thank you. Thank you for participating, for letting me participate.
Yes, great. And see you next time on the next webinar. Bye-bye.